Hi, I'm Dave Baldwin, and this is Laurie Lippman with LS Investment Management. And today in our video, we're going to be talking about
banking, Silicon Valley Bank, Fed monetary policy, inflation, recession, yes or no?
And we're going to go over just the overall market, what's been happening over the last quarter, kind of what we see going forward, and some sectors that we like.
Check out the video for more details.
All right, so Laurie, here we are, market update. Kind of the big news from the first quarter was the banking, crisis, the Silicon Valley Bank.
The crisis of two banks.
Yeah. Do you want to kind of
A few banks.
talk about that a little bit?
Yeah, I think it hit the news because Silicon Valley Bank is the banker of the Bay Area, has a lot of startups. But the issue that behind what happened to Silicon Valley Bank is a long story. And I think, Dave, you've been following that quite closely.
Yeah, so if you go back to 2 years ago, interest rates were really low. And Silicon Valley Bank wanted to try to get more yield. And so they were buying, at the time, what was long duration bonds. And that came with a little higher yield, but that also came with the risk of when interest rates go up, those bonds lose the most value.
Sorry to interrupt you, but if you don't quite get how that works, the interplay between interest rates and bond values, check out Dave's bond video, also on our site. It'll explain it nice and easy.
Yeah, and so the idea really that the bank wanted more yield, was using that, those investor dollars to go out and buy these longer duration bonds, and then when interest rates went up, those bonds lost money, and the depositors started getting nervous. And, technology really made it possible to kind of get the word out very quickly. And you started to see a lot of these depositors going in and trying to get their deposits out, over the course of just a couple of days.
Even less than that. It was over a weekend. They were able to pull a lot of money out. And so that's why it collapsed so fast. Any run on a bank can have that effect. We were joking in the office about how It's a Wonderful Life explains this very well at the end of the movie when George Bailey is explaining that your money isn't sitting in the bank. It's sitting in someone's home. It's sitting in their car. It's sitting, you put the money in and it gets let back out. Now the FDIC makes banks hold a certain percentage so that money is available to us, but they're never holding all of it.
Yeah, and these startups had, millions of dollars, and they were moving it all at once. And, you mentioned FDIC, 250,000 is that limit for FDIC insurance. And so the vast majority of individual depositors have less than $250,000 in the bank. But these companies had millions. And collectively, once they just started taking all that money out over the course of a weekend, it was just, the bank couldn't keep up with that. So the fear started to kind of spread, and the Fed's response was to, sort of step in and, one, take over the bank. But they also did something very interesting that kind of looked like a pivot from what their earlier stance was. And this goes back to, some of the other topics we've talked about with regard to monetary tightening, raising interest rates and trying to reduce that money supply and reduce the balance sheet, the Fed's balance sheet. And so all of a sudden when they said, hey, we're going to guarantee these depositors, it looked a whole lot like the Fed was changing their position. And now instead of the balance sheet getting smaller, the balance sheet potentially would have been getting bigger. That kind of led us to also this change in stance where prior to this, people felt like the Fed was going to raise potentially 50 basis points or 0.5%. And then they ended up only raising 25 basis points. So I think that looked like a pivot. But kind of what are your thoughts on that and also the Fed kind of going forward?
Well, I think the Fed, they had their eye on Silicon Valley Bank for quite a while. And they had warned Silicon Valley Bank for some time that they had these bonds on their books. They're not going to publicly say those things because they don't want what happened to the run on the bank to happen. So they try to work with the banks. But I think they've made it very clear that their oversight, that maybe they need a little bit more. They're going to keep an eye on things. And I think that was the reason they lowered the interest rate from 50 basis points to 25, was to let everything calm.
Yeah. But, again, I don't think that there has been a pivot. In the grand scheme of things, the Fed is still fighting inflation.
Yes.
Right? I mean,
they've made that very clear.
Exactly. So we did just have an inflation report come out. So again, this is being recorded April 13th. So really just yesterday, the CPI report came out showing that inflation has gone down. So it was at 6% year over year in February. After yesterday's report, it's showing that now for March, it's 5% year over year. So, I mean, it's working, but I don't think that means the Fed's done.
No, I agree with that. I do not think the Fed is done. I think we're probably going to have a couple more small 25 basis points.
So right now, as of today, the current rate sits at 4.75 to 5. And May 3rd is the next Fed meeting. So we don't, know, we don't have a crystal ball, but it's pretty likely there'll be a 25 basis point increase at that meeting. And then, potentially maybe one or two more. But I think that the target, some people are sort of estimating that the Fed may go as high as 5.5 to 5.75, somewhere in that range. So it's still to be determined, but I think we could continue to see that interest rate going up.
Yes.
So, I mean, that goes back to, inflation being sort of the goal, trying to slow down inflation, right? Higher rates mean less borrowing. Less borrowing means less economic activity, less consumption, less spending, less growth. That has a sort of tendency to bring on a recession, right? I mean, you're trying to slow down growth. And so we've had a lot of talk of a soft landing. What are your thoughts about a potential recession?
Everything seems to look strong. People are still spending money. That's why we still have the inflation. I think it's not going to be that tough. We have to remember to differentiate the markets with the economy. And the markets don't like high interest rates, and they've made that clear. But people keep spending, people keep going out, people are traveling this summer. So I think it will be a soft landing.
Okay. Yeah. And we had talked about this a couple videos ago about technically the definition of a recession is 2 consecutive quarters of negative growth, which we had. But there was a reluctance to call it a recession. And part of that, we sort of, argued maybe that jobs were part of that kind of, we had high employment or, very low unemployment. And so a jobs report just came out, last week, which showed that there was still an increase of 236,000 jobs so that would have been in March. And to put that in context, if you look back at March of 2019, so pre-pandemic, the economy had added 196,000 jobs sort of in that period.
Right.
So, I mean, we're still at an elevated, jobs number above where we were, 3 years ago. And so, that, I think we still have good employment numbers. So that with that jobs report in March, that put the unemployment rate at 3.5, which is actually down from 3.6 the month prior. Right. So do we get back into the same situation where, because we have such a strong jobs market and because, the stock market continues to perform, is there reluctance to call it a recession even if we see a slowdown in economic activity?
Always.
Yeah, right.
So as we talk about these recessions, one of the things that comes up a lot is, does an inverted yield curve lead to a recession? Is that part of it? what the impact does that have? Can you tell us more about that?
Yeah, so an inverted yield curve, well, let me first kind of explain a yield curve. If you think about borrowing money in different amounts of time, so if you were to borrow money for a year versus borrowing money for 10 years, normally, the longer that you're asking to borrow money, the more interest you would have to pay to borrow that money. And so a normal yield curve would point towards short duration, or like 6-month, 1 year loans or CDs or bonds would be a low interest rate. The longer that is, the more interest rate when you look at that on a graph. And we'll put a graph up on the screen. But the longer that time frame is, the more the interest rate is. And it kind of paints this yield, or this yield curve. And right now, what we have is the short-term loans are actually at a higher interest rate than longer-term loans. And so that yield curve is backwards. It's inverted. It's upside down. And if you look at it from the perspective of the lender, you want to try to make as much money as possible. So you would rather lend money for short periods of time than long periods of time. If you look at that from the perspective of the borrower, you would rather borrow money for longer periods of time, because then your overall repayment is stretched out over a longer period of time. Your payment's lower.
Right.
So if you're a company who's trying to expand, build new factories, hire more people, do something to grow, you want to borrow money for long periods of time, but there's a lack of desire to lend money to you for a long period of time. So that inverted yield curve generally tends to point towards recession. Again, because it's just slowing down economic activity. There's less of a desire to lend money for long periods of time. So I think that does sort of point towards the potential for a recession. But as you mentioned, an economic recession does not necessarily mean the stock market goes down. The stock market tends to price in the idea of what's coming. And this has been the most well-telegraphed recession. I mean, everybody's been talking about it. Like it's an expectation that we're gonna have a recession. So as far as the overall market, how do you think that responds to, or how do you think that reacts to recession fears?
I think the market has already priced a lot of that in. When we look at what is the people are talking about according to recession, it changes as the Fed has continued to increase rates, but they're thinking, we're going to top out at that 5.5% to 6%, and then check and see if there's a recession next year. They anticipate rates coming back down again. All of that is already priced in. So when the Fed pivots, or jobs come back, inflation comes back, they're going to make those adjustments. And I think when we look at history, it's been very positive.
Yeah.
I kind of joke that things are on sale right now, because when you look, all these companies are doing well. Their stock prices are down. Doesn't mean that they're a bad company. It just means people are a little afraid right now.
Yeah. And I think that there are some things that can point towards volatility in the market. In the past, I would have always said, stock prices follow earnings. Mm-hmm. And I think, we're looking at potentially earnings kind of going down, right? So if the definition of a recession is 2 consecutive quarters of negative economic growth, there's kind of the buzzword now has been an earnings recession, where you have 2 consecutive quarters of negative earnings growth. Mm-hmm. And so we did see negative earnings in the fourth quarter of last year. Mm-hmm. And so that was, earnings fell 4.6% from the year over year from the previous quarter. The prediction, now again, this is the beginning of April, earnings season kind of starts this Friday, tomorrow, and then, for the next couple of weeks. But the prediction is that we could see a decline of, 6 to 7% earnings again. So, that would have pointed me to think, hey, stock prices generally follow earnings. However, that hasn't been the case for the last 6 months. The market low was, back in October, 6 months ago. S&P, was down to about 3,500. Since then, the S&P's climbed. Mm-hmm. So over that 6-month period, now we are sort of in this band, sort of somewhere between 4,200 on the S&P and 3,900 on the S&P. So, I think that's where we start to see this sort of volatility, and we just got to trade in that window for a while.
I agree with that. I think we will continue to see volatility. I think that's just kind of a new normal, is because high-speed trading and all the algorithms and that kind of stuff, we are going to see a lot more volatility. But yes, even though they anticipate the growth rates are going to be slightly smaller, companies are still in business, and they're still doing well, and consumers are still buying. And so the market has realized maybe they're not going to grow as much, but they're still going to grow. They're still going to make money in what they do. They're going to price appropriately based on what the markets are doing. And so I think we do have a nice future of what we think is going to happen.
And I think that goes back to the sort of separating the market as a whole, right, versus individual companies or sectors that, if a company's run well and they have profits and shareholders, more people want to own profitable companies than not profitable companies, there is sort of an opportunity for active management. So instead of just owning an index or owning the S&P 500, maybe there's an argument in there to very specifically own certain sectors or certain types of companies that, again, are profitable, have pricing power within their product or service, so they can overcome inflation and still make a profit.
And a lot of companies are taking advantage of their stocks being down, and they're doing buybacks. And they're buying their own stock, which has less than the market, which increases the value. So they're creating value even without selling more of their widgets.
Yeah. And so I guess one other area that, could point towards some more volatility for the market, for a long time, interest rates were really low. And so if inflation exceeds the interest rate that you're receiving on your money, then you're losing purchasing power, right? So when inflation last summer in June was 9%, and at the time yields were 0.5%, you're losing money safely, right? Like, you're in bonds, so hey, it's not going down, but I'm not able to purchase as much as I could. So the alternative was to own stocks and to take risk where a stock could potentially go down, but it can potentially go up, versus a bond where the yield isn't enough to keep up with inflation. I'm sort of guaranteed to lose value. Now, though, inflation's come down to 5%. Bond yields are about 5%. So there's no longer that sort of loss of purchasing power. There's sort of you're just staying flat, right? You're not losing money safely. You're just sort of keeping the value. Does that then incentivize investors to start moving more towards fixed income? And if there's less demand or less volume in equities and more demand, more volume in bonds, does that kind of affect the market?
I think that's an interesting question. I think definitely people are going to flow more towards bonds, as we would call it, low-hanging fruit. We can now get some interest. That's the good part about inflation and rates going up, is that if you look at your bank account and the zero interest rate or yield is no longer zero. It's up. You're making money on cash, which we haven't seen in a really long time. Some of our younger clients have never seen it. But I think that's also going to give some competition to stocks, especially dividend-paying stocks. Maybe we'll see some rise in dividends so they can keep up, so people keep the stock and don't buy bonds. But I think we have some unique opportunities now, as we're in this higher interest rate, to compete with stocks and reduce our risk.
And within our own portfolio recommendations, we've sort of added more. We've taken from the equity side of the
portion.
Yeah, and move that over. Thank you. Move that over to be a little heavier weighting within fixed income. So some of those sectors that we do want to watch, And I feel like this is kind of, I got to admit when I'm wrong. I think that, I was a little bearish on technology. I felt like technology had been sort of overpriced. And, I think that there actually is a lot of opportunity there. One of the things you pointed out before was technology solves problems. So again, I think one of the problems we're facing is wages are high. It's expensive to employ people. If you have technology that can kind of step in and do some tasks that it now takes less people. The big news, over the last quarter has been, Chat GPT or a lot of the AI technology that, again, here's basically a computer program that can write computer programs. Do you need to employ as many programmers if you have a system that can more or less do some of that? So long story short, I think technology, again, I'm coming around. I think technology is a sector to continue watching. I'm very excited about those companies that are in that space, that AI
The
space.
innovative.
I don't know yet that those are the companies, but think about what they're doing for other companies that can utilize that technology to streamline their business, be more profitable. So I'm excited about technology.
I agree. I think we are, as Dave was saying, we're going to need technology to replace our retiring workers. We don't have enough workers. And one of the lines I liked from our company CFO was, a worker takes 20 years to grow. So you have a big lead time in knowing if we're going to have enough workers to replace the ones that are retiring. And we don't at the moment. And so I think here's where technology is going to encompass a lot of that, especially in areas we see in hospitality, in those areas where we're already seeing a shortage.
Yeah.
Are there any other sectors you're excited about or think?
Well, I think international. You had kind of talked about that before. Some of the things we were worried about internationally just weren't as bad. So there was a warmer winter than normal, right?
Yes, England and Europe got a much warmer winter, which helped with natural gas prices. They thought were going to skyrocket. We'll put up a chart that shows, natural gas prices are coming way down now. So that's good for the international markets.
And we're moving into summer, so again, there's less demand as far as energy for heating, and it gives them some time to kind of figure out some more options, right? One bit of news that kind of made some attention, got some headlines, was sort of how oil is priced. Normally, it's priced in dollars. Most, all international trade commodities are priced in dollars, and kind of a shift where China is kind of partnering directly with Saudi Arabia to just buy oil in the Chinese currency, the yuan. Kind of, what are your thoughts on that? Is that something to worry about?
I don't think that's something to worry about. Not that in the future we might see that the US dollar may not be the currency it's traded in, but when we look at the history of why the US dollar was chosen as the currency, trade currency, it's because of our Constitution, it's because of our entrepreneurship, it's because of the way we have free business. Those countries don't have that, and because they're government controlled, there's no freedom, there's no entrepreneurship, there's not a lot of owners, there's no of products. We have patent protections here, and if you don't have those things, then it can't be trusted in the way that the U.S. can. So the countries, those currencies, those countries don't have any of those. So there's not a big worry now that the U.S. dollar is going to be replaced. In the future, maybe, but not anytime soon.
Yeah, and I think, history-wise, I mean, there's the Brentwood Act, or Bretton Woods Act, after World War II, Europe had to rebuild. You had, the U.S. didn't really have to rebuild because, we were protected by oceans on both sides of us. So, Europe needed commodities, they needed resources. We had a lot of resources, and that was where that agreement originally came from, that, hey, we'll trade in dollars. You give us all of your gold, we'll give you all of our dollars, and then you give us back all those dollars and we'll give you all the resources you need to rebuild. And that helped us build up Fort Knox, and they got all the resources they needed. That may have been key to putting the US dollar in a dominant position, but that's not the reason that the dollar has now stayed there. And so for all the reasons you point out, yes, that we are the world's dominant currency, and China imports a majority of their energy. So it makes sense to a certain extent that they
These
would
two
just
countries.
they would just buy directly in their currency. So we're not too worried about the dollar losing its dominant position on the world stage.
I also like small caps. I think as we're coming out of whether or not it's a recession or not, small caps tend to do well because they're small and nimble and they can maneuver. So I think that's an area we want to keep an eye on. Are there any other you have?
No, I think, again, we go back to this idea of active management. And I think that instead of just owning an index like the S&P 500 and owning a little bit of everything, this is one of those times where we want to be invested in active management, whether that's individual stocks or mutual funds, where they're selecting very specific stocks or sectors that make sense. So that's something that we continue to watch and monitor, and I think that's active management really is. This is their time to shine.
I agree, and I think we can put up a chart that shows when you look at all the sectors each year, it's never the same sector. And actually, I've seen recently some that are doing it by quarter or by month, and it's not even the same. And that's how you really want active management, because you want to make sure you're taking advantage, of the bargains, things that are undervalued, where we think things are going to go. And I think being that nimble and being able to maneuver and not being held to an index and having to hold a certain percentage of something that may not be doing well, but you have to because it's in the index.
Yeah. All right. Well, certainly, thank you for watching this video.
Please like us.
Yeah, please like us and subscribe. We do these pretty regularly, so check back and we'll keep you informed on what we see going on in the market.
Thanks. Have a great day.
Thank you. Bye.